Coming up on Market to Market. Drought-influenced corn prices prompt hog producers to consider tough choices. And America's first major high-speed railroad could be the end of the line for some farmers. Those stories and market analysis with Tom Fitzenmeyer next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, September 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Public and private reports this week revealed waning demand for manufactured goods. According to the Commerce Department, orders for durable goods fell 13.2% last month in their largest decline since January of 2009. Most of the slide was blamed on a huge drop in commercial aircraft orders. But stripping out the volatile transportation sector, orders still fell 1.6%. Exacerbating concerns of a slowdown, the Chicago Purchasing Managers Index fell to 49.7 in September, indicating contraction for the first time in 3 years. The government also reported this week that consumer spending rose 5% in August. But that development turned out to be bittersweet since the gain was driven primarily by higher gasoline prices. Economists monitor consumer spending closely because it accounts for about 70% of U.S. economic activity. The all-important consumer could be asked to swallow higher food prices in the months ahead due to drought-reduced crop production. Surprisingly, though, experts say consumers won't be spending more for pork products, at least not for a while. Paul Yeager explains.
The great drought of 2012 is making a significant impact on livestock producers. A small harvest is driving up prices that will likely remain high after rain begins to fall.
The drought, of course, is taking its toll. That's going to have a long tail on it, though, because you've got some financial resources there in some producers' hands that will allow them to weather the storm. But we've seen an increase of cost up, and sometimes the forecast for next year has been $1 a pound on carcass weight pigs. It's down to about 95 cents now. Those kind of cost increases are tough, and they've put producers in a position to lose a lot of money this fall, between $40 and $45 a head for the pigs sold October, November, December.
Steve Meyer of Iowa-based Paragon Economics says all producers will feel the pinch, but good management may win out again.
No, I think it's going to be across the board. And the medium to small producers, though, have some advantages, and a lot of them produce a lot of their feed. And so they may not have that big a cost level in those bushels that they're going into their herds, where the large producer has to buy all of their feed. So it's probably going to boil down, though, to, as it usually does, the person that's kind of the best manager and the savviest at managing risk. And there have been, we've learned a few lessons about that in the last 5 years, so I think we're better at it. But I don't believe it's going to fall particularly hard on any one size class.
Stay on. Hey, stay on. Come on, let's go, pig. Come on. Let's go. Yeah. You're all right today. Yeah.
Some producers are sending their animals to market earlier than normal, hoping to beat the high grain prices. Hog slaughter is up 5% in the U.S. at near record levels, and hog prices have fallen 20% since June.
Now, I know of some large operations that are trying to take, 10 or 15 pounds off of market weights. Well, you can't do that very quickly. And that's the reason we've had such big slaughter numbers in the last 6 to 8 weeks, is those last few pounds of gain have just been very uneconomical. And so producers said, well, we're not going to put them on, and we pulled these pigs ahead. I think we're going to continue doing that because we're not going to get any real break in the cost situation. And if that's the case, we won't see slaughter get substantially smaller until we get to a point where you start going back to normal kind of weights. If you look at the weights, they're about the same as they were 6 weeks ago. But that's a time period when weights normally go up 3 or 4 pounds. So relative to what normally happens, we have reduced slaughter weights.
Meyer cautions producers to calculate production costs carefully to maximize profit opportunity.
Absolutely. I mean, it's a marginal cost and marginal revenue thing. I mean, if the pound of gain is worth more than it costs you to put it on, you do it. If it doesn't, then you better stop because you've gone beyond the point of maximizing profits. So do what's best in your operation is my advice. And if you see that pound is costing you more than it's worth, then don't do it.
The Agriculture Department reported that as of the end of August, pork supplies in commercial freezers were 16% larger than a year earlier. The flooded market of product benefits those in the grocery store today, but that may not be the case much longer.
Well, they're going to feel the impact on a good way in the short run because those hogs moving earlier are going to put some more product on the market. We've had hog prices trade down, the cutout value is down, and so there should be some buys this fall as retailers feature that product. I think that's going to be a positive in the short run. In the long run, those prices are going up, and that I'm talking third and fourth quarter of 2013 here. It's higher for all meats, and not just pork. It's going to be more expensive beef, chicken, turkey, everything's going up.
This week, Britain's National Pig Association predicted a world shortage of bacon because of the drought. USDA says fears of domestic bacon deficit were overblown, but Europeans may see less portions of pork.
Oh, yes, we're going to have plenty of bacon. I mean, as I've told many interviews this week, it's not a shortage in a stand in line to buy gasoline way that some of us know about. There will be lower pork supplies in the future, and the prices will be higher. But I don't think there's going to be any reason to panic that you're going to be able to buy bacon over the foreseeable future anyway.
As part of his $787 billion stimulus package in 2009, President Obama included $8 billion to build high-speed railroads. Up to $3.5 billion of those railway funds could go to California, which is about to begin an ambitious project linking San Francisco and Los Angeles. Voters approved a $9 billion bond issue several years ago to begin construction, but the massive project is expected to cost anywhere from $68 billion to $100 billion. And with the Golden State now hundreds of billions of dollars in debt, sources of additional funding remain to be seen. Nevertheless, construction is slated to begin soon in California's Central Valley, an area commonly known as America's Salad Bowl. And as David Miller discovered last spring, the need for speed could be the end of the line for some local farmers.
The idea of riding a train at speeds of more than 200 miles per hour has long been the dream of many around the world. While common in Europe, Japan, and China, the idea has been slow to take root closer to home. Several states have attempted to spark regular high-speed rail service, but the likely contender to be first is California. Tom Richards is vice chairman of the California High-Speed Rail Authority Board.
When you think about what the alternatives are in California, the surface transportation system, the highway system in California was designed years and years ago, decades ago, for a population that was somewhat less than 20 million people. A new assessment of current population growth that just came out earlier this week or last week, which reduces what the anticipated population is by mid-century, but it's still estimated at 50 million people.
When completed, the 800 miles of track will comprise the largest transportation infrastructure investment in state history. Traveling at speeds of up to 220 miles per hour, passengers will travel from San Francisco to Los Angeles in just over 2.5 hours, nearly 40% faster than by automobile. While official High-Speed Rail Authority figures show the project costing $68.4 billion, other estimates approach $100 billion. But even before funding was approved by California voters in 2008, many voices joined together against the plan.
There's no need at this time for this type of train. There will be maybe in the future, but right now, look at us.
The concern with high-speed rail is the lack of a stable financial plan, which the letter mentions.
We are mostly scared that the process has not been followed.
What is that going to do to those of us that live on that west side of the freeway? Are we going to be able to have access to be able to get across? Or are we going to be stuck driving 45 minutes around just to get to basic services?
And I had a question for Tom and the High-Speed Rail Authority, and it's been a month. That question was, give us a study, how many Fresno jobs are going to be lost? So, Tom, do you have an answer to that? See, that's the problem.
Manuel Cunha is president of the Nisei Farmers League, a San Joaquin Valley-based farmer advocacy group with 1,100 members.
So the league said, you know what, we're going to fight this thing. And the reason for fighting it as well is we have a couple of our members, Japanese Americans, they're going to lose their grandparents' home. The United States took U.S. citizens, Japanese Americans, and put them in camps, relocation centers, as they said, to protect them. These several Japanese Americans, their grandkids today that are 40 years old, 50 years old, they're up in arms because this high-speed rail is just going to tear through their home that they were born in by their parents that lost their home and got it back.
The initial phase of construction is slated to take place in the Central Valley of California between Merced and Fresno. Despite objections by most of the county governments in the area, Democratic Governor Jerry Brown signed a bill in mid-July authorizing the sale of $2.7 billion worth of construction bonds. The money will be matched by $3.3 billion in federal funds, allowing for the first 130-mile section of track to be laid. The steel rails will cut through a portion of the valley's 6 million acres of cropland, which produces a good share of the nation's winter fruits and vegetables.
This high-speed rail is going to cut down the normal flow of traffic from east to west in this basin. Every mile we would have roads to go back and forth. Now that's going to go to every 10 miles. So we're going to cut off major thoroughfares, and they're going to go down other side roads, and then find yourself a massive overpass to come back over and then go back again. So we're going to have more travel time from the standpoint of people going to work, school buses. Definitely a great concern for people's safety.
The original plan was to create an independent path connecting the major urban centers of California. But in order to reduce the price tag by nearly $30 billion, a new route was created combining dedicated roadbed and existing right-of-way. The California High-Speed Rail Authority estimates 320 billion fewer vehicle miles will be traveled over the 40 years following completion of the project in 2028. Officials with the Golden States Rail Board predict 12 billion fewer pounds of greenhouse gases will be produced and 237 million gallons of auto fuel will be saved annually. Nearly 120 million people are expected to take advantage of the faster service by 2030. The High-Speed Rail Authority says at least 600,000 construction jobs and 450,000 permanent jobs will have been created when the entire route is completed in 15 years. Officials also say it will help revitalize communities along the line, but Cunha believes the project will be devastating to local farmers.
So the jobs in my industry are going to be huge to loss. And they're saying, well, we're going to put those people to work. No, you're not. Don't fool me. Because you're talking about people operating major big equipments, which is tied to the unions and tied to other issues. And those aren't going to be those jobs that are around here. They're going to come from other states that have economic problems. And they could even come from those countries that we're going to buy the steel from or the train from. We don't make the trains around here, and we don't make any steel around here. So all of these together are going to be controlled by a very small group of people. But we're going to lose all the jobs that we have here.
Thousands of acres of private property will have to be purchased or acquired in order to complete the massive transportation project. The state of California will need 4,500 acres alone to finish the Central Valley line.
I may have to ask two neighbors to the west of me if I could go through their land to go farm my other piece of ground, whereas before I farmed it all in one spot.
We have to mitigate those implications or impacts. Part of what we believe works is the same thing that's worked in Europe. And what's worked in Europe is where you have land swaps. So you may have a farmer that's being impacted over here, and we understand that. But there is an opportunity perhaps to swap that piece of property that's been affected with the property owner to the other side of that.
While Cunha and the Nice Farmers League say they won't press any legal buttons for now, 3 lawsuits have been filed by various groups to stop construction of the Central Valley project. Officials with the High-Speed Rail Authority have stated they plan to seek common ground with each piece of litigation, but refuse to comment on the pending cases. and questions remain over how the massive project will be funded. To date, allocated state and federal funds amount to less than 10% of the project's total cost. Nevertheless, the Central Valley project is proceeding at full speed. Requests by California's High-Speed Rail Authority for bids on the 4-year-long undertaking have already been made, and construction is expected to begin next spring. For Market to Market, I'm David Miller.
Next, the Market to Market Report.
The Agriculture Department released its quarterly stocks report Friday, cutting old crop corn supplies to just 7% of total production last year. Wheat supplies were also reduced, and consequently, both commodities traded sharply higher. December wheat rallied 47 cents on the news Friday, wiping out losses in previous sessions and resulting in a weekly gain of 5 cents. Corn reacted even more strongly to the report, as the December contract traded limit up Friday and settled with a weekly move of 8 cents higher. USDA's projection of 169 million bushels of old crop soybeans in supply proved to be more than the trade expected. Nearby beans rallied anyway on Friday, but not enough to negate losses in previous sessions, and the November contract settled with a weekly loss of 20 cents, while nearby meal prices eked out a gain of $2.50. In the softs, cotton trended lower this week as the December contract lost $2.60. In the dairy markets, October Class 3 milk futures gained 64 cents, while the deferred contract was off a penny. Over in livestock, December cattle lost $3.77, nearby feeders were off $4.35, and the December hog contract was down $1.22. In the financials, the euro lost 140 basis points against the dollar, crude oil lost 70 cents per barrel, COMEX gold declined more than $4 per ounce, and the Goldman Sachs Commodity Index moved fractionally higher to settle at 664.10. Here now to lend us his insight on these and other trends is one of our regular market analysts, Tom Fitzenmeyer. Tom, welcome back.
Thanks, Mike.
We're glad to have you here. It's been an interesting week in the markets. QE3, Ben Bernanke's quantitative easing infinity, is still going on. What kind of effect is that having on the broad markets and on the commodity market specifically?
I think particularly the precious metals are responded pretty strongly to it. The equity markets have too. I think that's where the real impact's been. It's really been hard to see any impact directly on the grain markets, maybe tangentially to the livestock, but not very much there either. So I think that the macro help. I guess the question is whether that really. Liquidity's never really been the problem here, and so I don't see where adding more liquidity is going to do a lot. So I don't really see, in terms of agriculture commodities, that it's going to have that much impact.
Even when it relates to exports, is the cheapening of the dollar going to help us with these high prices?
Well, certainly the cheaper dollar under normal circumstances would be helpful, but corn exports were only 400 metric ton, and that's 400 with only 2 zeros. And we need to run about 430 to 440,000 metric ton per week just to meet the USDA's projections.
Oh.
So if you're not exporting anything, the dollar doesn't really matter all that much. And on the bean side, all those exports are going to China, so a weaker dollar relative to the yuan might make some impact, but I don't see that as a big factor either.
Not going to be a driver going forward.
Correct.
All right. Let's look at wheat a little bit. Had a big move today after a little bit weaker week. Where do you see it going forward?
Well, we had a huge fund liquidation in wheat and corn all throughout the whole week. That report on Friday was certainly supportive. We've got some really dry conditions out west that are making winter wheat, people planting winter wheat, apprehensive about even going out and planting. So I think that's going to be a supportive factor. We have been competing. We're getting beat up pretty well, actually, out of wheat and grains out of the Black Sea area. Their supplies are starting to dwindle a little bit. That should be supportive. So I don't see wheat going up and making new highs or anything, but I think you could see it be well supported in here. If you had some carry through buying after the strong closes on Friday of maybe 30, 40 cents, I'd probably become a seller once again.
Okay. All right. And so you see this range continuing for a little while?
I do, yes.
All right. Into beans, what do you see there? We saw a little bit of a rally today. Well, not much of a rally, I guess, a little bit of a rise. what does next week look like?
Well, there was a bit of a surprise in that report on Friday morning in that the USDA went back and increased the 2011 crop, which kind of caught people off guard, raised yield a little bit, raised harvested acres a little bit. If you'd looked, the stocks numbers actually, if you didn't have that 37 million added back in, came in about where the trade was expecting it to. I think there's a perception anyway that the harvest reports are coming in saying yields are a little better than the trade is expecting, and I think they're starting to maybe nudge up their estimates of what that's going to be on the October supply-demand report. The other thing is I think there's a little fear that maybe they're going to nudge the acreage up too. There probably will be a little follow-through on Monday to the higher closes, but beans were mostly just pulled up by the corn and wheat markets, and I don't really expect a lot of big follow-through there in the short run. Now, the bean market's very interesting because our export sales are at 77% of what the USDA is projecting for exports. We're only 3 weeks into the marketing season. So we've sold a ton of beans, and that has everybody wondering, are we going to be able to yank those out of the farmers' hands at adequate numbers to satisfy the needs? Now, our marketing year isn't going to really be a year. It's going to be 6 months because probably we're going to have a huge South American crop to satisfy the market's needs. But drawing those beans out of farmers' hands, you're going to have contract beans sold. You're going to have a certain number of beans sold out of the combine just because the price is pretty decent. But what gets locked away is going to be hard to get your hands on.
And so for producers out there who are getting a better yield than they'd expected, how high do you see beans going once we get through harvest?
I think there's an outside chance we could retest the highs at 1780, 1770, somewhere up in there. I certainly think you could see it back above 1650 without a lot of difficulty. Plus, I think you're going to see pretty good basis improvement. So I guess I'd want to have any excess I had, I'd want to put in the bin and kind of watch it at least into that Thanksgiving, Christmas time period.
All right, let's look at corn. Big rally today. What do you see in corn next week?
Well, they got everybody leaning really, really hard the wrong way on corn. Everybody's been nervous about how the USDA was going to handle all this early harvested corn. Traditionally, you don't have a lot harvested before September 1st. This year, by some estimates, we had as much as 1.2 billion bushels harvested. So it was, how is the USDA going to sort that out? And they actually, turns out they did a fairly good job on it. So everybody that had all those fears, apprehensions, they sold, as of this morning, had sold almost 36,000 contracts of corn. The funds had getting out of long positions. So everybody's leaning the wrong way. It comes in neutral to a little positive, and boom, up we go. So I would expect we're going to see follow through on the strength from Friday into the Sunday night, Monday trade, and then we'll have to see what everybody's attitude is. I mean, again, we've had fairly decent yields. We have killed off export demand. Livestock numbers are off. Ethanol industry is fairly stable, so I guess we'll have to sort it out from there. We're probably going to see corn in a trading range from 7 on the low side, or 705, the low we put in Friday morning, to close to 8 is kind of on the upside.
All right, so sell the rallies as they come across.
Absolutely, yeah.
All right, let's talk livestock just a little bit. You mentioned them briefly there. Where do you see feeder cattle going forward?
Well, if you're going to have strong cattle, strong corn prices, you're probably going to see overall weakness in feeders. Now, there have been a lot of people that chop silage because they didn't think their corn was going to be that great, and hoping to run that through calves, and I think that's helped support calf prices, and it's probably going to continue to do so through the winter. So I don't, if they break back, I don't see them breaking back a lot. The fat market's probably going to be, hover around that 130 area. That should tend to be supportive too. So I think you can buy feeders on a good sharp break here. If you get that recovery rally on corn, breaks feeders, maybe that's the chance to get some of those bought up.
All right, and you mentioned fats around 130. Did you see that through Thanksgiving?
Yeah, on the December contract, okay. It's trading around 125 and 125 plus. I think you could see a recovery back up to 130. We've got a lot of heavy cattle, And there's a reason for that. Everybody says, well, why are producers putting all those weight on cattle with high-priced corn? And there's a couple reasons. One is you look at the deferred contracts in cattle. Each progressive one is higher price, which is a signal to producers, hey, if I hold on to these cattle, they're probably going to be worth more. So there's some incentive there. And I think the replacement cost is so expensive. Figure, well, maybe I'll put a few extra pounds on the one that I've got and then see what happens with the projected higher prices. So that's the reason. The problem is it creates a lot of tonnage, and it really put a lot of pressure on beef prices this week. I would expect the lows if they weren't put in, were close to them, the lows we put in this week, and I would expect to see some firming into that Thanksgiving time frame.
All right, so firming in the midterm, and then generally bullish as we look into next year?
Out into next year, there's a lot of optimism. The question, and that's factored into those April, June, February cattle contracts. The question we have here is there's no doubt that the numbers are going to be down. The second question is, are they going to continue to put weight on the cattle? And then the third and biggest question in my mind is, are we going to be able to sell that expensive beef? Your report earlier in the show showed that pork's going to be very competitive. That's going to be a problem. Chickens and poultry is probably a problem. So the question then becomes, can we sell beef at higher prices?
All right, really quick, let's talk hogs. Rough week, where do you see hogs going?
Hogs have worked back up really nicely over the last month. I would expect that there's a little more in those on the upside, maybe not a lot. We traditionally have about a $10 rally. When hogs move, they move $10, and we've had 7 or 8 of that already. So a couple of bucks more up, and then I think you're going to see that tend to stall out.
All right, stall out there around Thanksgiving time again.
Right.
Okay. All right, so we'll keep an eye on that in the midterm for hog producers.
Okay.
Great, thank you so much, Tom. Really appreciate you being here tonight. That wraps up this edition of Market to Market. But if you'd like more information from Tom on where these volatile markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.